As India heads into Budget 2026-27, one word is dominating market conversations: pressure. Pressure, especially in the domestic bond market. Because this year, a surge in government borrowing is coming. India's sovereign bond market is staring at supply of nearly 30.5 trillion rupees. So what is driving this pressure? And why could the bond market be heading into a stress test? Let's break it down. The strain is building from both ends of the borrowing pipeline. Market estimates suggest the central government could borrow around 16.5 trillion rupees in gross terms next year. At the same time, state governments are expected to raise close to 14 trillion rupees. Put together, total sovereign bond supply could reach about 30.5 trillion rupees in FY27. For context, total sovereign issuance by the end of the current financial year is estimated at 27.05 trillion rupees, including 12.45 trillion rupees from states. A key trigger lies in policy design. The revamped Rural Employment Program, the Viksit Bharat Guarantee for Rozgar and Ajivika Mission or VBG-Ramji, shifts a larger share of funding responsibility to state governments. That means states will need more funds, and to raise them, they'll increasingly turn to the bond market. Economists say the centre may still stay on track with its fiscal targets, but collectively, states will have to borrow more, adding to overall supply pressure. The trend is already visible. According to a recent RBI report on state finances, state market borrowing has expanded steadily over the past 2 decades. Most large states have budgeted higher borrowing for 2025-2026. And in the first half of the current financial year alone, states' market borrowing rose 21% year-on-year. This growing dependence on bond markets is reshaping the yield curve and tightening borrowing space, not just for governments but also for private companies. On the centre's side, the fiscal glide path is expected to remain intact. Market participants estimate the FY27 fiscal deficit at around 4.3% of GDP, consistent with gross borrowing of about 16.5 trillion rupees. But there is another pressure point. Around 5.5 trillion rupees worth of government securities are set to mature in FY27. The RBI is estimated to hold nearly 1 trillion rupees of these. To avoid draining liquidity, the RBI could opt for bond switches into longer maturities. Alternatively, the government may lean more on treasury bills to manage borrowing without overwhelming the long-term bond market. Economists caution that this is not just a one-year issue. Over time, the bond market has relied increasingly on the RBI to bridge demand-supply gaps. At the same time, domestic savings have moderated. With government bond supply expected to remain elevated in the years ahead, analysts say structural solutions will be needed, including a broader domestic investor base, deeper foreign participation, and more long-term capital. For more stories around Budget 2026, follow Business Standard.